Ladies and gentlemen, good day and welcome to Yes Bank Limited Q1 FY23 Analyst Conference Call. On the management panel, we have with us today Mr. Prashant Kumar, Managing Director and Chief Executive Officer, Yes Bank, Mr. Niranjan Banodkar, Group Chief Financial Officer, Ms. Anita Pai, Chief Operating Officer, Mr. Rajan Pendle, Global Head Retail Banking, Mr. Akash Suri, Country Head Stressed Asset Management, and Mr. Ravi Tota, Country Head Large Corporates. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar from Yes Bank Limited. Thank you, and over to you, sir.
Thank you, and very good evening to all of you. And thanks for joining Yes Bank Q1 Financial Results Call. With me, I have the top management of Yes Bank, Rajan, Anita, Niranjan, Ravi, and Akash. Let me start with the key updates available on slide 3 of the investors presentation. The bank has successfully come out of the reconstruction scheme after the shareholders approved formation of alternate board with effect from July 15th. And presently the board consists of 7 independent directors, 2 non-independent directors, and MD and CEO. During the quarter, bank, or I will be saying on the 15th of July, the bank has signed a binding term sheet with potential ARC partner towards sale of stressed assets. Pursuant to an objective board run process, the binding term sheet was signed with partner JC Flowers to acquire an identified pool of 48,000 crores of stressed assets of the bank. A swift challenge auction has been launched with JC Flowers base bid of 11,183 crores, which is roughly 135% of carrying value on the balance sheet as of March 31st. Pursuant to successful closure, this is said to be the largest sale of stressed assets in domestic markets. Coming to Q1 financial results, we are pleased to report consistent improvements across all our core operating metrics as well as the strategic objectives. In the quarter gone by, the bank has achieved the following. On the profit and loss front, during the quarter, the bank has reported a net profit of 311 crores, which is an increase of 50% YOY. The net interest income of the bank at 1,850 crores has increased by 32% YOY. The bank's NIM stand at 2.4%, which is again up by 30 basis points. The non-interest income, excluding the treasury income, is up by 35%. The core fee income driver continues to show significant traction with sustained momentum in retail banking fees, which is up 43%. Corporate trade and cash management business and increased digital transactions have also resulted in higher interchange income on YOY basis. The operating profit for the quarter stand at 590 crores. Excluding the treasury gains, operating profits have increased by 33% YOY. The total provision cost at 175 crores is lower by 62% and is the lowest quarterly provision cost since the reconstruction scheme. The bank's operating expenses are at 2,042 crores, which is an increase of 6% quarter on quarter. The increase in operating expenses is due to increase in loan sourcing fee on account of a strong business momentum, a step up in IT investment, and employee increment and increased welfare expenses, including health insurance. On the advances front, the advances have grown by 14%, of which retail have grown by 42%, medium enterprise at 33%, SME at 15%, while the corporate book has shown a decline of 9%. Retail MSME and corporate mix has improved by another 200 basis points now to 62 for retail and MSME and 38 for the large corporate. New sanctions disbursement aggregated to roughly 23,000 crores during the quarter across segments. Despite decline in net advances for the corporate segment, our new business generation continues to be strong with wholesale disbursement of 5,237 crores during quarter one. The bank is confident of meeting the 15% loan growth guidance for FY23. On the deposit front, as on June 30th, our total deposits are 1,93,241 crore, which is showing an increase of 18% YOY. The CASA ratio stands at 30.8%, with CASA and retail term deposits together constituting 62% of total deposits. The customer acquisition momentum continues with more than 3 lakh CASA accounts opened during the quarter. Growth in liabilities has come despite reduction in interest rates, which is a reflection of our superior customer service and stakeholder confidence. Our cost of deposits continues to reduce and is now at 4.8%, which is down 60 basis points YOY. Saving account balances have grown by 39% YOY, while current account balances have grown 25%. Average daily current accounts have actually grown at 50% YOY, mainly on account of our digital solutioning to the e-commerce and fintech players. On the asset quality front, the gross NPA number has improved to 13.4% against 13.9% as on March 22. Similarly, net NPA ratio has also improved to 4.2% from 4.5% as on March 22. The slippage at 1,072 crores, of which corporate slippage is stand at 619 crores, retail at 368, and the rest is for SME and medium enterprise. Slippage out of the restructured pool at roughly 126 crore, which majorly consists of one large exposure. The increase in the overdue loan of more than 30 days by 1,700 crores quarter on quarter, predominantly on account of one large infrastructure group fully backed by strong and highly valued collateral. The resolution momentum continues to be strong, with total recoveries and upgrades of 1,532 crores, and we remain on track to achieve our annual guidance of recovery and upgrades of more than 5,000 crores. On the capital front, the bank continued to accrete capital organically, with CET ratio at 11.9% and total capital adequacy at 17.7%. The risk-weighted asset to total asset has improved to 73%. Bank has seen a net addition of 802 employees during the quarter. During the quarter, we have launched on the multiple fronts. We have taken initiatives for welfare of employees and also for upgrading the skills of our employees, along with taking some special measures for our women employees, including the training for both top leadership as well as for the middle and the junior management. We continue to focus on new customer products and propositions, and we have launched a first of its kind floating rate fixed deposit linked to the RBI repo rate. This is an intelligent fixed deposit with dynamic return, and we already have more than 14,000 customers on this product. All the above points demonstrate a strong momentum in the build-up of a good quality franchise. Our slides from 20 to 41 in the investor presentation provides a detailed update on the entire franchise of the bank. As we complete the first quarter of FY23, we are confident of achieving our strategic guidance provided to you earlier, which I would like to reiterate. 35% CASA ratio, further improve the retail corporate mix, advances mix by 400 basis points, more than 15% advances growth, where the growth in retail, SME and medium enterprise would be more than 25% and 10% loan growth in corporate segment. We would sustain the CD ratio below 100%, the recoveries and upgrades to be more than 5,000 crores, ROA target of 0.75% and 1% to 1.5% over the medium term. With this, I want to thank you all once again for taking the time out for joining this call and wish all of you and your families good health and prosperity. We can now open the floor for your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maruk Adajania from Edelweiss. Please go ahead.
Hello. Hello, sir. So I had a few questions. Hello, sir. So I had a few questions on earnings, but before that, I just had a question on the ARC. So basically, you did mention about the transfer, which is the gross value of assets. But newspaper reports talk about this same gross value, and they say that the net value of assets is around 83 billion or something like that, 8,300 or 8,500 crores. So what I wanted to check is that basically 85% of that 8,300, in the worst case scenario, if there is no recovery, will come as provision. Is that the correct understanding? And what will be the aging profile? Means over what period, if at all there are no recoveries, of course there will be, will these have to be provided for?
So, Manu, I think the first point, that 15 or 85 is not out of that 8,300. The assignment value, which is 11,100, okay, we would be getting 15% cash out of it. Okay, and since the net carrying value is lower than the assignment value, this cash would further bring down the value of the SR which we are going to carry in our books. Okay, as per the current regulation, the provisioning on the SR would be in accordance with the provisioning on the NPAs. Okay, so it means the SRs would also continue to attract the provisioning as per the aging of the NPA. Okay. But today we are carrying a net value of 8,300. We would be getting a 15% of the 11,100, which would further bring down our SR net carrying value. Okay. So it means fundamentally the impact for us would be only the aging provision for the net carrying value for the SR which would be carrying in our balance sheet.
Got it, sir. So, the net carrying value will be 83 minus cash. That way?
Right.
Got it, sir. 83 minus full 15% cash. Hai na?
Yes, yes.
Got it, sir. Got it. And sir, how, given the profile of these assets, they'll age over how many years? Over 1 year, 2 years, according to RBI guidelines?
So this is a mix. This is a mix between 1 to 3 years kind of thing.
Got it, sir. Got it. So my next question is that you did give growth guidance, which looks strong, retail, corporate. So what are the risks to this growth, given that in general investors remain concerned about a global slowdown? Any risk to the growth, or you think the base is low enough to generate this kind?
I think as of now, we are not seeing any impact on the demand side. Okay. Either on the corporate side or also on the retail and SME. But we need to be absolutely cautious in terms of how things would move, because things are very uncertain. How the interest rate would move not only in India but globally, and how it would impact the Indian economy. So I think everybody is very cautious about this, but currently we are not seeing any impact on the demand side.
Got it. And sir, you think deposit gathering will not be an issue, not only because of rising rates, but also possibly because of HDFC Bank?
No, I think the issue is more in terms of, yes, liquidity has come down as compared to past, but still getting deposits to support the loan growth currently is not a challenge. The only thing is the pricing for all the banks would go up in line with the movement in the rate of interest.
Got it, sir. Got it. And sir, any outlook on margin?
So currently our NIMs are at 2.4% and we are expecting NIMs for around 2.75% for the full year.
Got it, sir. Sir, and sir, was there any mark-to-market loss in the quarter?
That's about 37 crores.
Yeah, just 37 crores.
Got it. That's it. Okay, sir. Thank you so much. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, if you want to ask a question, you may press star and 1. The next question is from the line of Jay Mudra from B&K Securities. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity and thanks for the detailed presentation also. So firstly on this alternate board, so the proposal was there would be 2 SBI directors and 2 RBI directors. So as of now, there are 2 SBI nominated directors, which are these 2 non-independent directors, and there is no RBI director. Is the understanding right?
Absolutely.
Right. And sir, now that you have an alternate board, I mean, what is the significance of this? How does this change? I mean, of course, is a good milestone that you have achieved, and you have completely have come out of this restructuring scheme. But does this, sort of changes anything in terms of business or in terms of your ability to do business?
No, I think the formation of alternate board would not be impacting any of these kinds which you are mentioning. I think it was more like a large financial institution was put up under a reconstruction scheme, okay, which was brought in by Government of India under consultation with RBI. I think we are not aware, we have not seen any parallel that a large financial institution is successfully able to come out from the reconstruction scheme. So I think that is something which is very important, and that is the performance, the delivery in the last 2 years where the bank has been successfully come out of the reconstruction scheme, new board has been formed, and now it's a growth path for the bank.
Understood. Understood, sir. And second thing, sir, on this ARC deal, I mean, I just want to understand the mechanism. So let us say the base value, let us say it is finalized hypothetically at 12,000 crore, just to keep the numbers, calculation easy. You get 15% of that as cash, which is 1,800 crore. The rest you get all in security receipts. Right, so you have a carrying value of let's say 8,000 crore, which reduces by 1,800 crore. The rest, so the net NPA only declines by 1,800 crore in the first tranche, in the first leg. The second leg would only be as and when you redeem the security receipts. Is that understanding?
So I think just one clarification which I thought. Then we would be carrying the SR to the extent of 6,500.
Sorry, what is that? 5,500.
So, Jai, hi, this is Niranjan. So, I think in your example, you took a 8,000 crores carrying value. Is that correct?
Yes, sir. Yes.
And you said 1,800 is the cash. So 6,200 is the post-transaction net carrying value. The only minor, I would say, from a classification standpoint, the change would be the NNPA will actually move into, from the 8,000 crores, will move into a security receipts of 6,200 crores. Investment in security receipts.
Correct. And sir, if you have, and so let us say your security receipts in not an aggregate basis, but for a particular exposure, is zero, right? Let us say, and you have got security receipts of 10 rupees. Hypothetically, you are in the money on security receipts, right? But you cannot book that notional profit anywhere, right? That is right.
Good. Yeah.
Right. Okay, sure. And the third thing is, sir, on cost to income. Sorry, on this recovery of 5,000 crore, that the target that we have. And I think we have done fairly well in this quarter also. You have already included this ARC transaction, right, which will, let us say, give you roughly around 2,000 odd crores as cash, right? So this 5,000 crore includes that already, right?
No. Jay, the 5,000 crore is separate from ARC transaction.
Okay, understood. And sir, there was a media mention of one film exhibitor having gone into NPA. Has that been, that was some, a sizable amount. Has that been already NPA in first quarter, or that could come in second quarter?
It was an NPA in the last financial year.
Okay, that was already an NPA in the last financial year.
Yeah.
Sure. And the last question is, sir, you have given detailed guidance, and of course you have given milestone, and we are on track on most of them, or maybe almost all of them. On cost to income, right? So this looks clearly bloated at 71 or 75% plus. So in your guidance of over 75 basis point ROA, how should one look at the cost to income for the full year?
No, even for the full year, our guidance on the cost to income is around 70-71%. Okay, and the reason for this is also since we have started on the growth phase, and since there is a higher focus on the retail and MSME, I think at this point of time it is important to have those kind of investments which would start giving you the revenues over a period of time. Similarly, I think not only for us, for any bank, it is important to keep on investing in the IT infrastructure. Okay, and since we are very strong, we also have a responsibility of supporting the digital transaction of the country. So I think we would continue to make investment in our IT infrastructure. We would continue to expand our business, and in the initial year, the cost to income would be definitely higher. But as the revenues would increase, it would start coming down.
Right. Understood, sir. Thank you so much for your time, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Soumya Jain from MK Global. Please go ahead.
Hello, am I audible?
Yeah, please go ahead.
Yeah. Congratulations, sir, on the results. Sir, I was going through the presentation, so I wanted to know what is the breakup of SMA1 and SMA2, that if you could give the numbers for the same.
I think in the presentation we have given the number of the government.
I'll just share the number. Page 17. You can go to page 17 of the presentation. There we have the breakup between 31 to 60 days and 61 to 90 days overdue.
Oh, okay. Okay, sir. And one last question, sir. Initially you had mentioned the guidance that you have given as 38% CASA, 400 bps advance growth, 15% advance growth. So I missed on the breakup in the segments. Advances, what is the target for advances growth in the retail and corporate? If you could just repeat that, that would be very helpful.
So on the retail and MSME, we are targeting it more than 25% growth, and on the large corporate, 10%.
Thank you, sir.
Thank you. Anyone who wishes to ask a question may press star and one now. The next question is from the line of Saurabh from JP Morgan. Please proceed.
Hi, sir. Good evening. Sir, two questions. One is essentially on this NIM, that's critical for meeting your ROA expectation. So the rise which you would be forecasting is just mix-led, or would you be modeling some kind of, cost of funds improvement once you raise capital?
Saurabh, can you please repeat this? We are not able to hear.
Not able to hear you well.
Okay.
I would request Mr. Saurabh to increase the volume of your headset, please.
Is this better, sir?
Yeah.
Hello? Is this better?
You're audible. Please proceed.
Yeah. So just on this, on the drivers for NIM, net interest margin, sir, are you just forecasting an increase basis the improvement in mix, or would you also be looking at some kind of, funding cost reduction once you raise capital?
So, on the NIM, to begin with, when you look at this quarter, we should have basically already seen some increase in the loan yields. We have not seen the commensurate increase because a lot of the repricing which was linked to either the EBLR or the MCLR is actually yet to kind of fully play out. So assuming on an as-is basis, there is already a 7 to 8 basis points of margins which will come through in the next quarter or two. So I think that's one element. The second is in terms of how we look at deploying our excess liquidity. I think CD ratio we're already at about 96%. So I think we will continue to improve on our loan spreads. I think that's really the focus, and that is a function of how we get our cost of funding lower. So we are using every event to kind of continue to compress the spreads that we offer on our deposits to competition, and that's been a very historical journey for us post March 2020. So whenever we are seeing interest rates or let's say cost of deposits actually go up in the industry today, we have also increased, but we've not increased with the same intensity as the market. So I think we will use that opportunity to also expand. The third clearly is the mix in our cost of funding, which is on the CASA, within CASA, the proportion of CA, how that kind of also plays out. So it's a combination of these which will play into the net interest margins. The last element is also on the recoveries and resolutions, because that also plays in terms of the drag that I have on the net interest margin. So it's a combination of these four broad events.
Understand. But in the 0.75% ROA guidance, the NIM assumption will be around 2.9 odd percent. Will that be fair?
Say that again, please.
So for the ROA guidance of 0.75%, the NIM on that, I mean, to achieve that should be around 2.9 odd percent.
So we should be exiting at about 2.9%. For the full year, we should be at about 2.7 to 2.75%.
But the Q4 exit should be around 2.9.
That's right. Upwards of that.
Okay. And what will be the average cost of savings right now?
We should be in the 5% handle, sort of. Actually, sub 5%. Yeah. That.
Okay. And just one last question, sir. This on this large infrastructure account, which is in your SMA2 book, what's your expectation that this could potentially slip into forward quarters? And where are you exposed? Are you at the group company or in the SPVs?
No, I think we don't see any possibility of this account slipping into NPA category. And this account remains under SMA1 or SMA2 for a very, very long time. And the issue was more in terms of mismatch between the revenues and the obligations for this. But it's a strong company backed by strong security, and we don't see any possibility of slippage at all.
Okay, sir. Okay. Thank you. Thank you for your time, sir.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. So first question, in terms of this impact of ARC sale on GNPA and net NPA. So the way to look at it is in terms of the carrying value which is there, that will directly go out of the GNPAs, corporate GNPAs of 25,000 crores which are there. So maybe minus 8,800, and at the net NPA level, how would be the impact?
No, so Kunal, I think if we try to see in a slightly different way, the 48,000 crores of stressful assets which we propose to transfer to ARC is excluding of the slippage happens in the bank after 1st October, right? And similarly, some of the category of loans like foreign currency loans, which are regulatory, cannot be transferred to ARC, would remain within the bank. Okay. So it means when we would be exiting FY23, we would be having the slippage after 30th September 2021 and some of those category of loans. But we would also be seeing a recovery and upgradation from that pool also. And since our slippage guidance for the current financial year is 2%, so we would be expecting a GNPA number of between 1.5 to 2% by the end of the FY23. And the net NPA of something around 0.5 to 0.6.
Okay, so GNPA would be 1.5 to 2 and net NPA of 0.5 odd percent.
Yes.
Okay, of the overall. So this is broadly in terms of you're talking at the bank level.
Right.
Okay, so this entire corporate banking piece which is there, that would move out. So I just wanted to understand from the corporate banking GNPAs which are there, okay, 25,000. So how would that behave post the sale end up towards the end of the fiscal year?
So most of the corporates would be out. Okay.
Okay. So it has nothing to do with the carrying value on the balance sheet. So it will directly, the larger part of this file.
Entire pool will be out.
Okay. So that could be out, and same way you're talking about the net NPA. Okay. And in terms of this restructured, so again, when we look at the COVID-related restructuring, I think decline was almost 210 odd crores, and I think that's the number you highlighted in terms of slipping into NPA as well. So to that extent, fair to assume that maybe there has been no recoveries which are coming in from the restructured pool. And if we really look at it, when do we expect this pool to move out, and what are maybe what would be our estimate of the further slippage going forward on this 3,700 crores of COVID-related restructuring?
I think the behavior of the COVID restructured pool has given us a positive surprise. Okay. The retail and SME COVID restructuring pool is behaving very well. The customers are prepaying as per the restructured plan, and the collections have been extremely good. We have seen only one reduction on the corporate side from this COVID restructuring. Otherwise, the pool is behaving very well. But definitely, we can't expect the similar quality trends in the restructured pool also as compared to the remaining part of the loan book. There will be definitely some incremental delinquencies out of the restructured pool, but that would not be meaningful or significant.
Okay. And when does this actually move out? So when should we see it reflected? Yeah, maybe it will be September or it will be till March?
No, actually, because as per the COVID restructuring, they have been given a timeline for, I think, Ravi, any idea, 2 years or what? So I think it will take some time because as per the restructuring, they need to continue to serve and completely repay the FITS, right? Once they would make the FITS zero, then they would be considered out of the COVID restructuring.
Okay. Got it. And in terms of the overall expenses, I think maybe when it was under this entire restructuring scheme, I think that was the place wherein there would have been the cost cut or some ROA management through the operating efficiency. But in fact, that's growing. It seems to be pretty much on into the investment phase. And given the growth guidance which is there, how should we really look at this number? In fact, when we look at it, maybe 30% still seems to be low, and we will be investing it much higher getting forward into the next 18 to 24 months, or it should stabilize? Yeah.
Kunal, I am not able to get you very clearly on this question. Can you please repeat?
No, so I'm just saying that, 1-2 years have been the year of consolidation, okay, and maybe not too much of an investment. So definitely we have been building up the retail and the SME, and disbursements are going up. But to what extent we are done, okay, if we have to look at it in terms of our objectives, targets, how much of that investments is already done in the franchise, and we should now see more of a stabilization of the OPEX, or maybe we have just started off, maybe Q4, whatever numbers we are seeing, 33% rise, 6% quarter-on-quarter rise. Okay, that's just the start, and we should see the build-up over here in terms of the overall operating expense other than the employee.
So, Kunal, I think most of the investment would happen during the current financial year. Okay, and that's why we would be seeing a expense ratio of around 70-71% for the year FY23. And next year onward, this expense ratio will start improving. Though there would be a continuous investment which we would require, but I think the kind of investment which we are doing would also give us the proportionate increase in the revenue. And we are also bringing the overall efficiency into the entire system, which would also bring a lot of improvement on the expenses ratio.
Kunal, I think just one more point I also wanted to add is if you look at the cost to income thought process for the retail business is clearly higher than corporate, right? Just the cost to income. And over the last 2 years, what you have also seen very substantially is that the mix on the balance sheet or the assets is actually also moved in favor of the retail. So while in isolation, if you look at retail, you would have seen them on an improving trajectory from a cost efficiency standpoint, but just the sheer mix moving into retail has also meant that some of the cost to income ratios have been at 77-78% for this quarter, but largely we should 71%, right? But I think just coming to the point, this year, if you look at our cost to assets, we were at about 2.4%. I think that we have allowed to expand to 2.6% in June and possibly for this particular financial year, and that is coming on the back of multiple things, right, that Prashant just mentioned for this year. But we will see that offset coming in from the revenue to assets as compared to fiscal 22. We will see margins which expanded from 2.1% to 2.5 in fiscal 21. We should see the 2.4 that we are right now to exiting to 2.9%. So you will see margins to NII to assets actually offset that cost. One. Number two, there will also be, because June was in some ways coming off the back of a very good March quarter. Also, it was not a very comparable one from some of the retail business standpoint. I think we should see a good momentum sequentially also pick up. So the fees to assets should also do better. And if this coincides with also the contribution from corporate growth, because on a YOY basis, corporate growth has been lower, so that also will start supporting the cost to income quite constructively.
Yeah, so understand it from the income perspective, but purely on the cost side, would we allow this 2.6 to further expand, or it should stabilize? Yeah, maybe income, I think, there would be levers, but broadly in terms of the cost, is there the investment more which is still on, and will further allow it to expand beyond that as well? Yeah.
So Kunal, as I said, we will not allow the cost to assets now to go beyond 2.6%.
Okay, it will. Okay, got it. Yeah, thanks a lot.
Okay.
Thank you. The next question is from the line of Sri Karthik from Investec. Please go ahead. Mr. Karthik, I have unmuted you. Please proceed with your question.
Yeah, thanks. What would be the capital implication for the ARC transaction?
What is the possible, timing?
What will be the impact on our capital ratios because of the ARC transaction?
Well, the impact on it would be capital neutral, but due to some accounting entries, it would be having an impact on the capital. Otherwise, it's a capital neutral for us.
Understood. Okay, I'll come back in the queue again.
Thank you. The next question is from the line of Anand Dama from Emkay Global. Please proceed.
Yeah, thank you, sir, for the opportunity. Sir, if I'm correct, basically what you said in the earlier one of the query is that all of these 48,000 crores of NPAs which will move out to ARC is part of the current GNPA pool, right? Nothing is already written off?
No, it also includes almost 15,000 crores which has been written off.
Okay. So 48,000 crores minus 15,000 crores is the gross value which will move out of the GNPA, and how much will move out of the NNPA in that case?
How much of the?
So what is the net carrying value which is sitting into the NNPA pool at this point of time?
8,300.
10,300 crores.
8,300.
8,300 crores. And so secondly, the cash which you will receive from the ARC, certainly after the Swiss auction happens, now will that not really even partially flow into the PNL?
Sorry, is the question that will the cash flow into PNL? Was that the question?
Yes.
No, the cash will not flow into the PNL. The cash will actually go down to reduce the carrying value of the security receipts.
Of the security receipts. Okay. So there will be no PNL impact because of this ARC transaction at all. All that it will do is basically optically reduce the NPA ratios. It will move out of the balance sheet. It will go to the ARC. And secondly, there will be no capital impact as well. I mean, there is no capital release as well, right?
Right.
Okay. So in that case, the CET ratio being slightly lower than the peers, what is our capital raising plan?
So currently we are sitting with a CET of 11.9. We would definitely like to increase it to at least 14% kind of thing. So during the current financial year, we would see when this kind of opportunity would come, but we would like to raise capital in the current financial year.
Okay. Sir, any quantum?
Around $1 billion.
Okay. Great, sir. Thanks a lot, sir.
Thank you. The next question is from the line of Ankit Bihani from JM Financial. Please go ahead.
Yeah, hi sir. So I just had one question. I wanted to know what proportion of your loan book is floating rate, and of the floating rate, how much would be linked to repo?
So we have approximately 36% which will be at MCLR, and we'll have about 25% which will be EBLR.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Sagar Rungta from Anand Rathi. Please proceed.
Hello. Hi, sir. Just one data keeping question. What were the slippages, restructured slippage you mentioned? Thank you.
We had about 130 crore that has slipped from the restructured book into NPA.
Okay. Thank you, sir.
Thank you. The next question is from the line of Rakesh Kumar from Systematics Shares. Please go ahead.
Yeah, thank you. Thank you for the opportunity. So just coming back to this stressed asset sell to ARC transaction. So please correct me if I am wrong. Of the total transaction of 48,000 crore, we have got the bid of 11,100 crores. So basically there is a write down of around 77%, right? And we approximately have provision coverage of 83%. So we are going to get write back of the provisions of around 2,900, which you said just now that it will go towards reduction in the SR value instead of provision write back in the PNL. Correct?
Absolutely. Absolutely.
And this 1,600, 1,700 crore number, which is part of the cash, this will come into the PNL or what is that like? Against the sale of the stressed asset?
Yes, this would reduce the carrying value of the SR in our book.
But this 2,900, which is the difference between the PCR what we carry and what is the write down that JC Flower is giving. So this 2,900 should be routed into the provision line, right?
Sorry, Rakesh, can we just very quickly start with the numbers again? 2,900 reflects what?
Yeah, so according to the bid of 11,100 crore, so there is a write down of 77%. We are carrying the provision of 83%.
Understood. Okay. Let me just very quickly explain. So the first rule in an ARC transaction is that you have to record the security receipts at the lower of the security receipt consideration or the current book value, whichever is lower. So as a thumb rule, if I'm selling these at 11,000, let's say 11,100 ballpark, the carrying value is 8,300. I cannot have a balance sheet carrying value which is more than 8,300. That's the first step, number one. The second is that I can recognize anything into PNL only if I receive cash. However, because I have a principal outstanding, the PNL will be used to further create or reduce the value of that security receipt, which means on the 11,000, when I get the 15% cash, the 8,300 will be further reduced to get the carrying value to about, let's say 6,700.
Okay. And Secondly, on this slippage ratio number guidance, which we have provided at around 2%. So 3,700 slippage we are expecting on a gross basis in the remaining 9 months. And we have a slippage of 1,000 crore in the first quarter and 1,500 crore of recovery upgrade. So we have actually net slippage a negative number. So what is the credit cost that we are estimating or expectation that we have?
So Rakesh, our actually slippage is the way we are looking at the full year slippage is from a gross slippage standpoint. We've always said that this year our provisioning write back or the recoveries that we'll have from bad debts should be quite sufficient to offset any provisioning requirement that we will have on our existing book, either through slippages that we will have or the aging related provisioning that we have. So that let's say last year the provisioning to assets was about a 55 basis points. We should actually see a lower trending in fiscal 23 as a consequence of the recoveries that we will have, possibly in the 25 to 30 basis points.
And just coming back to because of this ARC transaction, because this net NPA number would fall, because we are we would have positive impact on the margin, correct?
Look, from an NII to assets, we should see I would say a marginal improvement. That's because to the extent of cash that we receive will go to improve the NII to assets. But from a NIM perspective, it's actually cosmetic. So I would say just from an NII standpoint, the cash that we receive is the real contributor to the NII of the bank.
Got it. Thanks, sir. Thanks a lot.
Thank you. The next question is from the line of Anusha Raheja from Dalal and Toja. Please proceed.
Yeah, so with respect to again this ARC deal, you said that reduction in the gross NPAs would be to the tune of 15,000 odd crores, right? Am I right there?
Sorry. Again, Kapur?
With respect to this ARC deal, the out of this 48,000, reduction in the gross NPAs would be to the tune of 15,000 odd crores?
No, we were saying like 48,000 crores includes 15,000 crores which has been technically written off and sitting outside the balance sheet.
That is sitting outside the balance sheet. 33 is the current carrying NPAs, because if I just look at it as on Q1, the current carrying NPA, gross NPAs is 27,000. So 15 is technical written off assets.
Ma'am, this also includes non-performing investments.
Okay. So can you just give up the breakup, like what will be the current carrying value of NPAs and technical written off, and what could be the restructured assets in this 48?
Ma'am, the carrying value in the balance sheet as of 31st March, which we've explained, is 8,300 across the NPA pool.
So that is the net
NPA. Which is going to be transferred to this year.
Yeah, and the gross is the 48,000 crores, including 15,000 crores of technical write-off.
Okay, so again on this, so what could be the reduction in the gross NPAs? 8,300 with the reduction in the net NPAs. What could be the reduction in the gross NPAs?
Gross NPA would be lower by about 26,500 crores.
Sorry, come again?
About 26,000 crores, 26 to 26,500 crores.
Okay. And when is the deal likely to go through? When it's expected to complete?
We have already launched a Swiss challenge process. It would take like around 75 days kind of thing. So I think the whole assignment would happen in the third quarter.
Okay. And, what are the estimates of flows expected, post sale of these assets to ARC? Like, it will have a pool of 48,000 crore. Usually you will be having a 20% stake. So it is pari passu, or how is it?
So on this structure, the security receipts that the bank will hold will be on a, say, pari passu basis. So like we said, that gross value being 11,183 crores. So that is in some sense, say, reflection of the prognosis that a third party has made. And say recoveries on the same will happen over due course of time.
So, the estimate that you have given of the NPA of, 1.5 to 2%, anything that is built into these numbers, the flows of ARC, anything is built into these numbers?
No, I think whatever, like, what I was sharing...
that will get reduced from SRs, I guess.
Yes.
But I did not actually understood why it will not have a P&L impact because, whether it will be received in cash or how the transaction is likely to happen. I mean, if you just can, because usually, if you get in cash, that's usually pari passu, right?
So the P&L impact will not be there because of the regulatory guidelines. The regulatory guidelines only allow, say, write back if in case, say, cash for that specific asset will be more than the net carrying value. So because of that, say, P&L impact will not be there, and this will largely, say, have a impact on the net book value of the security receipts. But the important point is that, say, from a economics perspective, you have to see that, say, a book which has net carrying value of 8,300 crores, that has been, say, bidded at 11,000 plus. So whatever is the delta, that delta would come back to bank as and when recoveries would happen.
Okay, so anything recovered beyond the selling price would add to the P&L, is that correct?
Sorry?
Anything, that you receive, from the ARC beyond the selling price, that could add to the P&L?
So, as and when the recoveries come?
No, not beyond the selling price, the point that Akash mentioned. So, let's say we keep getting the recoveries, would mean that we basically keep reducing the carrying value in our balance sheet. When the carrying value is effectively, let's say, zero, any recoveries over and above that becomes into P&L. So it's like in this particular structure, the P&L benefit of effectively 3,000, let's say 3,000 crores or 2,800 crores that we are talking about is kind of rear-ended from a P&L benefit standpoint. But it is there and it has been basically validated through the bidding process that has come through.
Okay. Okay, sir. Okay.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to Mr. Prashant Kumar for closing comments.
So thank you so much for attending this call. We hope we have been able to clarify your queries. But still, if there is anything where you require more clarification, you are most welcome to reach out to us. Thank you so much.
On behalf of Yes Bank, that concludes this conference. Thank you for joining us, and you may now